Imagine standing on the factory floor of the world's largest electric vehicle maker. Robotic arms move quickly. Workers rush to match the pace. Brand new cars come off the line every few minutes. The company is BYD. It shows industrial strength. But what if a massive invisible debt hides behind this scene? The debt acts like a time bomb. What hides in the balance sheet of BYD? Could the electric vehicle champion hide a financial risk nobody expected? BYD started in 1995. Wang Chuanfu founded the company as a maker of rechargeable batteries. The name means build your dreams. The big moment came in 2008. Warren Buffett through Berkshire Hathaway bought nearly a 10% stake. The investment was around $230 million. This gave BYD capital and trust to enter the auto industry. By the 2020s, BYD changed from a small player to a giant. The company grew with the electric vehicle boom in China. In 2023, BYD passed Tesla as the world's largest producer of electric vehicles. BYD made about 3.02 million new energy vehicles that year. This included hybrids. Tesla made 1.84 million. To show the scale, the vehicle output of BYD grew 10 times since 2020. It went from roughly 400,000 to over 4 million units each year. Now BYD produces more by volume than Ford, Honda or Nissan. The value of BYD is around $150 billion. This makes BYD the third most valuable automaker in the world. Only Tesla and Toyota rank higher. This fast rise made BYD a national hero in the push of China for dominance in electric vehicles. Investors love the growth of BYD. But during this quick expansion, questions started. People wonder if the financial side of BYD matches the production strength. Are the books of BYD as clear as they seem? Or does the company boost growth by adding hidden duties? The answer comes from a part of operations in BYD called supply chain financing. In January 2025, a group based in Hong Kong called GMT Research released a strong report. GMT Research watches accounting and flagged troubles with China Evergrande before. The report claims BYD depends heavily on supply chain financing to fund growth. In basic terms, BYD extends payment times to suppliers. The company also moves receivables to hide a growing debt. Here is the main point. BYD reported a net debt of only 27.7 billion yuan officially. This was $3.8 billion as of mid-2024. But GMT adjusted for tricks in working capital. The true net debt rises to around 323 billion yuan. That is $44 billion. This is more than 10 times higher. This large difference happens because BYD removes many debt-like duties from the balance sheet. How? By selling or pledging accounts receivable, which is money owed to BYD. Also by treating very late payables as normal working capital instead of debt. Money BYD owes suppliers falls into payables. Nigel Stevenson, an analyst at GMT, spoke clearly. He said, however, it structures the setup, it clearly acts as financing. He called it hidden debt. He accused BYD of using tricks to show these duties as part of working capital. In short, BYD borrows from the supply chain but does not call it borrowing. One key method uses a platform inside BYD called DiLink. Auto firms usually pay suppliers within 45 to 90 days of invoice. BYD stretches payment terms far. It reaches 8 to 9 months. Data shows in 2023 BYD took an average of 275 days to pay suppliers. Some estimates earlier in 2023 said 257 days. This is 4 to 5 times longer than the global normal of 45 to 60 days. It exceeds even the typical 90-day cycle of Tesla. Through the DiLink system launched in 2021, BYD gives suppliers a promissory note or bill instead of cash. This acts as an IOU. Suppliers can hold the note until it matures and wait longer for payment. Or they can cash it early through a bank for a fee. By mid-2023, BYD issued a huge 400 billion yuan of these notes to suppliers. This equals about $55 billion. This shows how much BYD relies on this practice. From the view of BYD, this acts as smart short-term financing. It keeps cash now since suppliers wait to get paid. Technically, it keeps debt off the books of BYD because these count under working capital. But the analysis from GMT argues to recategorize those unpaid invoices as debt that bears interest. Then the leverage ratios of BYD rise sharply. The net debt-to-equity ratio of BYD is not the small 15% the company claims. It actually goes above 200%. That means over 2 times equity. This level of gearing fits a troubled property developer more than a healthy automaker. Observers compare this to Evergrande. The Chinese real estate giant collapsed in 2021. Years of off-balance sheet debt gains came before the fall. Just as Evergrande used creative financing to hide duties until too late, the supply chain finance dependence of BYD could build risk unseen. What pushed BYD to these extreme financing steps? Rapid expansion plays a big role. BYD differs from other car companies. The company scales at a speed rarely seen in the auto industry. In recent years, BYD invested heavily in new factories. Also in battery gigafactories, research and development centers, and global sales networks. The company launched new sub-brands like Denza Yangquang and Fangchungbao at the same time. Dozens of new models came out. BYD entered over 50 countries in a short time. This fast growth needs huge capital spending. This covers machinery, tooling, supply contracts, and more. To add complexity, the last 2 years brought a tough price war in electric vehicles in China. BYD cut prices sharply on models like Dolphin and Seal electric vehicles. The cuts aimed to beat rivals and take market share. Some models sold below cost. This plan worked. It removed weaker competitors and increased sales for BYD. But it also reduced profit margins across the industry. The margins of BYD stay relatively thin. They reach single-digit percentages. Cash from operations alone might not cover the large growth investments. When selling cars cheaply to gain volume, the company must find cash from other places to continue expansion. BYD founded in working capital. The dominance of BYD from the price war gave strong power over suppliers. As smaller electric vehicle firms closed or reduced, suppliers grew more dependent on big players like BYD for work. BYD could set harder terms, like pushing payment deadlines further. Many suppliers had few choices but to agree. Some suppliers even use promissory notes from BYD as collateral to get bank loans. They treat IOUs from BYD as good as cash. In a way, BYD financed expansion using suppliers. Suppliers indirectly lent money to BYD by waiting longer to be paid. This setup helps both but carries risk. BYD gains growth capital. Suppliers stay active, hoping to get paid later because BYD promises large order volumes. The result shows clearly on the balance sheet. Accounts payable and other payables for BYD grew hugely. These line items hold the supplier IOUs. At the end of 2021, other payables for BYD were about 41.3 billion yuan. By the end of 2023, they quadrupled to 165 billion yuan. This sharp rise signals how much cash BYD borrowed effectively from the supply chain to meet capital needs. In simple terms, the strategy of BYD for growth at all costs uses an unusual source. It uses money from other people, specifically from suppliers. This allowed BYD to invest more and produce more than competitors without always using debt markets or equity financing. But it brings a hard question. How long can BYD continue this? The financing tricks of BYD also highlight gaps in governance and transparency. None of these practices break laws or accounting rules directly. Supply chain financing appears in many industries. Companies worldwide factor receivables or extend payables to handle cash flow. But good corporate governance needs clarity so investors can measure risk. On this, BYD shows opacity at best. One warning sign is the little detail BYD gives about swelling other payables. Investors expect companies to explain large liabilities on the balance sheet. The other payables line for BYD hit 165 billion yuan by end of 2023. It gets minimal explanation in reports. This lack of transparency led GMT and others to think a big part relates to supply chain financing duties. By comparison, a peer like Geely includes specific breakdowns. Geely covers dealer advances, accrued expenses, and financing payables in filings. The absence in the case of BYD means investors see partly in the dark. They cannot easily tell normal payables from more troubling IOUs hidden in that line. Also, BYD mostly refuses to comment on these financing practices when asked by analysts and media. The silence of the company added to criticism. The company portrays a net cash position in earnings reports. This almost repeats the "trust us, nothing to see here" attitude some companies used before financial issues appeared. Comparisons to Enron or Luckin Coffee might go too far, but the idea of unclear disclosures matches. Investors must trust the narrative of BYD even though raw numbers suggest a different reality when adjusted. On governance, the board and auditors of BYD should act more to clarify these off-balance sheet setups. An external firm like GMT Research had to build the true debt picture. This shows a lack in disclosure from BYD. International accounting standards move toward more transparency on this. Both United States generally accepted accounting principles and international financial reporting standards added rules recently. They require companies to show effects of supplier financing on liabilities and cash flows. This means global firms must tell investors if they use payables or supplier finance heavily to fund operations. BYD lists in Hong Kong and Shenzhen. The company will likely face pressure to match these standards. This aims to keep trust with international investors. In summary, while BYD follows rules on paper, the minimal disclosure on a large pile of quasi-debt questions governance. True transparency would mean BYD details clearly how much financing hides in working capital and the terms. Until that, trust suffers from the gap between the public financial story of BYD and the real situation. The situation of BYD does not happen alone. Regulators and industry watchers pay close attention. Financial authorities in China learned from past corporate failures like the Evergrande debacle. They grew wary of hidden leverage in all areas, including automakers. In 2023, stock exchanges in China took steps to check the supply chain finance issue. The Shanghai and Beijing exchanges questioned at least 2 suppliers of BYD about how they account for promissory notes from DiLink. For example, one materials supplier explained why revenue dropped about 40% after adjusting for note financing. Profit rose though. The reason was the solid payment record of BYD let the supplier reduce provisions on those notes. Another equipment vendor faced questions on why it carried no bad debt reserve against notes from BYD. It said notes from BYD were AAA rated and posed no credit risk in the view. These inquiries from exchanges show regulators push for clarity and careful accounting down the supply chain. This indirectly pressures BYD to share more with partners. On a larger scale, the China Securities Regulatory Commission works to better corporate disclosure and control financial risks. No specific rule caps how long a company can extend payables yet. But regulatory words suggest authorities dislike practices that delay payments too much to boost cash flow, especially if it harms smaller suppliers or hides leverage of a company. After all, the government in China balances carefully. It wants national champions like BYD to succeed worldwide, but not if it creates new systemic risk. Beijing urged companies publicly to self-regulate in the ongoing price war for electric vehicles. Also to keep sustainable business practices. Though that message focused on pricing, the deeper meaning is clear. The government does not want victory in market share for electric vehicles to become a costly win due to financial fall. Internationally, rating agencies and global investors change how they see automakers in China. Rating agencies now include the chance of soft defaults in assessments. Soft defaults mean companies delay supplier payments. This happens when judging creditworthiness of Chinese electric vehicle firms. This change tells much. Analysts no longer assume a company will pay all bills on time or default fully. They see a middle where firms stretch payables instead of defaulting on bonds. This accepts that supply chain financing became key to how the Chinese auto sector works. If true, regulators might set formal guidelines later. For example, require more disclosures in financial statements. Or set industry norms for payment periods to stop extreme cases. Also, in recent years, regulators in China tightened checks on off-balance sheet liabilities after big debt scandals. For property developers, they stopped shadow banking and hidden guarantees. Similar moves could come in manufacturing. For instance, require large firms to report adjusted debt figures that include supplier financing. Or mandate stress tests that assume those payables come due. Any changes would affect the public financial metrics of BYD directly, likely showing the leverage GMT highlighted. In turn, this could push BYD to reduce reliance on these tactics, or find other funding like raising more equity or bonds to pay off some hidden debt. Not everyone views the supply chain financing of BYD as a sign of coming failure. Some analysts note counterpoints and factors that ease concerns. This could mean the situation of BYD carries risk but stays far from a crisis like Evergrande. First, the hidden debt, but to whom? One counter is that much off-book financing of BYD goes to state-backed banks or stable groups through those supplier notes, not to unstable shadow lenders. Suppliers often sell promissory notes from BYD to banks for early cash. Then banks wait on payment from BYD. Banks in China, especially large ones with BYD, stay generally strong or have government support. This setup means risk centers in entities the government can control or help if needed. Unlike the complex web of Evergrande with retail wealth products that hurt millions of households. So the idea is, even if BYD rides high debt, the government manages it. The government could tell banks to extend obligations of BYD forever if required. This stops a sudden problem. Basically, this sees the financing scheme of BYD as leverage approved somewhat officially, not a free chaotic setup. Second, changes from BYD show awareness. Reports say the company started shortening payable days a bit, also selecting more carefully in extending terms to suppliers, perhaps favoring those who take notes and paying others faster. Third, industry norms and changes. Another view is that many do it to some level. As seen, NIO and XPeng also delayed payments. NIO averaged 295 days to pay in 2023. Even more than BYD. If long payables become standard in electric vehicles in China, then BYD faces no unique risk. Or so the thought goes. Of course, these counterpoints do not remove the basic worries. They just suggest buffers and ways to stop the worst results. Investors looking at the situation of BYD should weigh both the negative view of unchecked hidden debt leading to trouble, and the positive view of gradual fixing of finances. Reality likely falls in the middle. The likely truth is BYD will face more checks and must change strategy. But if done soon, the company might keep reputation and adjust the business model. As with any company growing fast, governance grows too. What works in the high-growth startup phase when all chase scale often cleans up as the company grows older. BYD may stand at that point now. The story of BYD shows the mix of success and risk in the electric vehicle world. The company rose from battery maker to global leader, but the methods to fuel that rise now draw eyes. The 165 billion yuan debt problem hides in plain sight through supply chain tricks. Investors and regulators push for clearer views. Will BYD adapt and thrive? Or will hidden risks bring trouble? The answer depends on how the company handles transparency and growth. For now, the electric vehicle giant rolls on, but the time bomb of debt ticks quietly. Watch closely as the next chapters unfold.